Hello everyone, I'm Dr. Kalpana Naidu, Associate Professor from the Department of Commerce, Accounting and Finance, Women's Christian College, Chennai. In today's video, we will explore the deductions available for capital gain with a specific focus on Section 54F and how it differs from Section 54. Let's move on to the presentation. So what is Section 54 of your Income Tax Act 1961? Section 54F, it provides an exemption from long-term capital gains tax on selling any capital asset other than a residential property. This means that if you sell a long-term capital asset like shares, stocks, bonds, gold, etc., and reinvest the entire sale proceeds in a new residential property within a specified time frame, you can claim an exemption on the capital gain arising from the sale. Let us see what is the eligibility to claim an exemption under Section 54F. Now coming to applicability, this Section 54F applies to individuals and Hindu undivided families who have earned capital gain. The second is your eligible capital gain. It covers long-term capital gains from selling any asset except a residential house. Condition for exemption. To claim exemption, the taxpayer must use the sale proceeds to buy or construct a new residential house. Now, timeline, the taxpayer must buy a new house within 1 year before or 2 years after the sale, or in case if he is going for construction, it should be construct within 3 years. The extent of exemption, full exemption, it is allowed if the entire sale amount is reinvested. Otherwise, exemption it is given in proportion to the reinvested amount. Now, you have certain restrictions with relation to the Section 54F. The first one is your ownership restrictions. Now, the taxpayer must not own more than one residential house. This is other than the new one at the time of selling the original asset. And holding period, the new house must not be sold within 3 years or the exemption will be revoked and capital gain will become taxable. And exemption limit, it is given for the lower of the capital gain or the cost of the new house. Now there is a maximum limit of rupees 10 crore as per budget 2023. Next you have the deposit in capital gain account scheme. Now the capital gain account scheme is designed to help taxpayers defer the capital gains tax when they intend to reinvest the gains in purchasing or constructing a new house, but they are unable to do so before the due date of filing their income tax returns. Now, what is this ITR due date? That is your July 31st for individuals. So if a taxpayer sells a property and intends to reinvest the capital gain in a new house, but has not yet completed the purchase or construction, then the gain must be deposited in a capital gains account scheme before the due date of filing the ITR, which is usually July 31st for individuals. And this deposit ensures the taxpayer can claim an exemption under Section 54 or Section 54F of your Income Tax Act. Now, coming to the utilization of the deposited amount, the taxpayer must utilize the amount within 2 years for purchasing a new house or say 3 years for constructing a new house from the date of sale of the original asset. Now, if the deposited amount remains unutilized beyond the specified period, then the unused portion is treated as taxable capital gains in the year when the time limit expires. So here you can check out in a nutshell what is your section 54F. Like, it is available for individual HUF and it is available only to long-term capital asset except residential house property. Then you have certain criteria like when it has to be purchased, if the assessee is going for purchase of a new house, or if he is going for construction, what is the time frame. And if the entire net sales consideration it is reinvested, the full long-term capital gain it is exempted, else a proportionate amount depending on the formula. Like here you have the formula, it is long-term capital gain multiplied by the amount which he is investing and divided by net sales consideration. Now net sales consideration means your sales amount minus your selling expenses. Now let us see how your section 54F differs from your section 54. Now the first one, coming to your applicability, it is available to individuals and HUF on the sale of residential property, whereas here it is sale of any long-term capital asset other than a residential house. Right, so it is very clear section 54 applies when a long-term capital gain arises from the sale of a residential house property, whereas section 54F applies when a long-term capital gain arises from the sale of any capital asset other than a residential house. Example, it can be a land, it can be shares, it can be gold. Now coming to your investment requirement, which is the second important difference. Here for section 54, the capital gains must be reinvested in a new residential house in India. Whereas in section 54F, the entire sale consideration, not only the capital gain, but the entire sales consideration must be reinvested in a new residential house in India. Now how this exemption amount it is calculated? Under section 54, the exemption it is limited to the amount of capital gain which is invested in the new house. Whereas under section 54F, if the entire sales consideration is reinvested, full capital gain is exempt. If only a part is reinvested, the exemption it is proportionate. Next, moving on to the number of houses owned. Now coming to section 54, there is no restriction on owning multiple houses before selling the old one. Whereas under section 54F, the taxpayer should not own more than one residential house which is other than the new one at the time of sale. Coming to the lock-in period, under section 54, the newly purchased house must be held for 3 years or else the exemption it is withdrawn. And it is same for 54F also, like in case a newly purchased house it is not held for 3 years and if the assessee is selling it, then the exemption will be withdrawn. So both sections, that is 54 and 54F, helps in tax saving by reinvesting in residential property, but differ based on the nature of the assets sold and the reinvestment requirement. Now I hope you would have got a clear understanding of what is section 54 and what is section 54F. Thank you for watching the video.